5 European countries still offer tax deals most people have never heard of. Every one of them is on a countdown clock. Across Europe right now, 5 countries run preferential tax regimes specifically designed to pull in wealthy foreigners. We are not talking about shady offshore structures. These are fully legal, parliament-approved programs published in national tax codes. Portugal's IFICI, Greece's €100,000 flat tax, Italy's Article 24 bis at €200,000, Spain's Beckham Law, Switzerland's Forfait Fiscal. Between them, they cover every profile from a 35-year-old software founder to a retired hedge fund partner with €40 million in foreign dividends. Each one cuts a specific type of income tax from 40 or 50% down to somewhere between 0 and 20%. Each one locks in that rate for 5 to 15 years. And each one, according to public policy documents, political statements, and European Commission pressure, is scheduled to tighten, reprice, or disappear within the next 2 to 5 years. Portugal already ended the original in-char regime in 2024. Italy tripled its rate overnight in August 2024. Spain quietly narrowed Beckham eligibility in 2023. Greece is openly debated at the EU level. Switzerland is facing its own internal political challenge by Canton. This is the current state of the European tax deal map. Which regimes are real today, what they cost, who qualifies, and in what order the window is closing. Portugal shut down its famous in-char regime on January 1, 2024, but did not walk away from foreign tax competition. It replaced in-char with the IFICI program, sometimes called in-char 2.0, published in Decree Law 249 of 2023 and Article 58A of the Portuguese tax code. The new deal is narrower, but still sharp. A flat 20% tax rate on Portuguese employment and self-employment income, applicable for 10 consecutive years. Most foreign source income, dividends, capital gains, interest, and royalties, is fully tax-exempt in Portugal, provided it is sourced from countries with a tax treaty. Unlike in-char, IFICI is restricted to specific high-value roles. Researchers, PhD holders, university professors, tech founders, senior managers of qualifying innovative companies, and employees of approved export-oriented businesses. The Portuguese Tax Authority publishes an annual list of eligible roles and companies. Eligibility requires that the applicant has not been a Portuguese tax resident for the previous 5 years, and that they apply within the first year of new residency. Since launch, roughly 7,800 applications were approved in 2024, heavily skewed to tech founders from the UK, Germany, and Brazil. The regime is politically fragile. The Portuguese Socialist Party has already proposed further restrictions for 2026, and a 5-year sunset review is built into the statute. Greece copied the Italian model in December 2019 through Law 4646 and launched the regime in 2020. Article 5A of the Greek Income Tax Code offers a flat substitute tax of exactly €100,000 per year paid to the Greek state, which covers the entire worldwide non-Greek income of the applicant. Dividends from foreign companies, rental income from foreign properties, capital gains from foreign securities, royalties, carried interest, all covered by that single payment. Family members can be added for €20,000 each per year, slightly cheaper than the Italian add-on. The regime requires a real investment in Greece of at least €500,000, payable within 3 years of approval. Qualifying investments include Greek real estate, Greek bonds, shares in Greek companies, or approved venture funds. Duration is 15 years, identical to Italy's original design. The eligibility gate is 7 of the previous 8 years as a non-Greek tax resident, slightly looser than Italy's 9 of 10. Applications jumped sharply after Italy's 2024 hike. In the first half of 2025, Greek approvals rose approximately 340% year-over-year, with most applicants explicitly citing the Italian decree as the reason they switched. Greek officials have publicly stated the program will stay at €100,000 through at least 2027, but the European Commission has privately raised the same harmful tax competition concerns that led to Italy's hike. Most tax advisors treat Greece as the next likely repricing event in Europe. Italy's Article 24 bis flat tax is still alive, just 2 times more expensive than it was. After Decree Law 113 of 2024, the flat substitute tax stands at €200,000 per year, ratified permanently by Parliament through Law 143 of October 2024. All other regime features remain. Family add-on at €25,000 each per year. 15-year maximum duration. Full exemption for all non-Italian source income covered by the flat payment. Italian source income taxed normally on top. The break-even point has shifted. At €200,000, the regime only beats normal Italian taxation above roughly €465,000 of foreign income per year. Below that, an applicant is better off paying Italian tax at regular rates. Above that, savings scale sharply. A €5 million earner still saves about €2 million per year versus UK 45% top rates. A $50 million earner still saves around $21 million annually. The program is now concentrated in the top 0.01% of earners. Applications dropped 73% in the 6 months after the hike, and the average declared foreign income of new applicants jumped from €1.2 million to €4.6 million. Italy remains the best deal in Europe for anyone above $5 million per year of clean foreign income, particularly carried interest, dividends, and pass-through business income. Below that threshold, Italy has priced itself out of the market in favor of Greece and Switzerland. Spain's special regime, officially Article 93 of the Spanish Personal Income Tax Law, is universally known as the Beckham Law after David Beckham became the first high-profile applicant in 2003. It offers a flat 24% tax rate on Spanish source employment income up to €600,000 per year and a flat 47% rate above that threshold. Foreign source income is fully tax-exempt for most categories, the major exception being employment income, which must come from a Spanish contract or a foreign employer with a Spanish permanent establishment. The regime lasts 6 years total. The eligibility requirements were tightened in 2023 through Law 28 of 2022. The applicant must have been a non-Spanish tax resident for the previous 5 years, must have moved to Spain because of a new qualifying employment relationship, a board seat, or a highly qualified innovation role, and must not earn income through a Spanish permanent establishment except within the qualifying relationship. Since 2023, remote workers and digital nomads can also qualify through the new startup visa pathway, provided they work for a foreign employer. Approved applications in 2024 totaled approximately 4,200, with more than half being tech sector relocations from the UK and Germany. The regime is stable politically, as it is embedded in primary tax law rather than executive decree, but the €600,000 threshold has not been indexed for inflation and is a known weak point that future reforms may reprice. Switzerland's Forfait Fiscal, known in German as the Pauschalbesteuerung, is the oldest preferential regime in Europe in continuous operation since 1862. It is fundamentally different from the Italian and Greek models. Instead of a flat rate on a flat base, it taxes the applicant on their estimated annual lifestyle expenses in Switzerland, with a federal minimum taxable base of 434,000 Swiss francs, and typically a multiple of 5 to 7 times the applicant's Swiss housing cost. The resulting tax bill is negotiated individually with the canton of residence and usually lands between 200,000 and 800,000 Swiss francs per year, depending on lifestyle and canton. Rates vary. Geneva, Vaud, Valais, Ticino, and the Grisons are the most common destinations. Zurich and Basel-Stadt abolished the forfait for new applicants in 2009 and 2010 respectively. Eligibility requires that the applicant has not been a Swiss tax resident for the previous 10 years, does not hold Swiss citizenship, and does not earn any Swiss source employment or business income. There is no time limit. The deal can last a lifetime, making Switzerland the only major European regime without a maximum duration. Swiss applications rose 58% in late 2024 as Italian regime refugees looked for the next cheapest European alternative. The federal political landscape remains stable, but canton-by-canton abolition votes are an ongoing risk. The next scheduled referendum on Forfait status is expected in Basel-Landschaft within the current electoral cycle. Here is the honest timeline, assembled from public policy documents, European Commission correspondence, and party manifestos. The regime most likely to tighten next is Portugal's IFICI. A Socialist Party proposal to restrict eligibility further is already under discussion for the 2026 budget, and the program carries a formal 5-year sunset review in 2029. Second in line is Greece at €100,000. Greek Treasury officials have stated internally that the rate is likely to rise to match the Italian €200,000 benchmark sometime between 2026 and 2028, pending EU pressure. Third is Italy's €200,000 rate itself, which multiple opposition parties have threatened to reverse or raise further if they win the next general election. Fourth is Spain's Beckham Law, which is expected to see its €600,000 salary threshold reduced in the next reform cycle, likely 2027. Fifth, and most stable, is Switzerland's Forfait. Federal abolition is not on the table, and canton-level votes move slowly. But individual cantons have repealed it before, and new referendums can surface unpredictably. The practical read is simple. If you qualify for any of these regimes today and the math works, the best window is already now. Every one of them has a visible political deadline, and the pattern in recent years shows that preferential tax regimes rarely get better once launched. They get worse, or they get killed. The practical application path is identical across 4 of the 5 regimes. Step 1. Confirm non-residency in the target country for the required look-back period. Portugal and Spain require 5 years. Italy requires 9 of 10. Greece requires 7 of 8. Switzerland requires 10 years plus no citizenship. Document this with old tax returns, utility bills, and residency certificates. Step 2. Establish tax residency under local rules before or during the application. This generally means signing a long-term rental or purchase agreement, enrolling in local health coverage, opening a local bank account, and triggering the 183-day physical presence test or the Center of Vital Interest test. Step 3. File the formal application within the first tax year of residency. Italy requires a ruling letter from the Agenzia delle Entrate. Portugal requires registration with Financas. Spain requires filing Model 149 within 6 months of arrival. Greece submits Form A21 to the Greek tax authority. Switzerland negotiates the Forfait agreement directly with the chosen canton. Step 4. Document foreign income structure. These regimes protect foreign source income. Any income that could be recharacterized as local source must be handled carefully to preserve the flat tax treatment. Step 5. Budget approximately €15,000 to €30,000 in first-year legal, tax advisor, and relocation fees. The fee is small compared to the annual tax savings, but it is not negligible and it is paid up front. Total timeline from decision to approval ranges from 2 to 6 months, depending on country and caseload. If you're mapping your own European tax move and you want the raw numbers, the deadlines, and the political forecasts without the hype, subscribe for more. Every week we break down one country, one loophole, or one real workaround the other channels skip. Hit the bell so you don't miss the next one. We'll see you in the next video.